Hello guys, welcome to the sharpening session for today. I'm going to take my glasses off, I think. So let me just put the disclaimers up here on the screen, top left hand side. There they are. Please read them, even if you need to pause the video to do so. Now, the sharpening sessions that we do are sessions that we normally conduct over the weekend. And the reason for that is because most markets are closed. Of course, crypto markets are still open. You might have some other markets, depending on where you are in the world, that might either still be open or just opening over the weekend, depending on what time it is. But most markets are closed. And so that gives us the time to talk more conceptually, answer questions, discuss things that are more about the logic behind things, why we do things, why it is that we make that decision and not that decision, so that we can give you guys more context and background rather than in the sessions where we're trading futures or forex or stocks and we don't really have time to explain what we're doing and why we're doing it. We're just taking trades. Now, of course, we explain a little bit, but the sharpening sessions allow us to really get into, again, some of the more conceptual sides of things. Now, let me just take this moment to explain where you can go if you have questions, if you're watching this recording, or if you need any help or support or resources, different places to go. So let me show you where that is. Now, you've got different email addresses down here, becky@tradewithufos.com and also support@tradewithufos.com. So you can email us directly. Now, depending on what you need, normally a better place to go is to this link. It's tradewithufos.com/Becky, and that will take you to this link here. Now, from here, you can get apps, courses, coaching, which is the general live coaching that we all do. You can book specific one-on-one coaching with me if you'd like. If you scroll down a bit, this will soon to be filled in, but this will have some notes from the live sessions that I do. So the stocks and the forex sessions where I'm placing trades will all be logged here, so you can track those. If you scroll down here as well towards the bottom, there's a question and answer section. So you can ask a question here, or you may find the answer to your question is somewhere in here because somebody else has already asked that question. So loads of different resources, lots of different support and help, most of it from this link here, tradewithufos.com/Becky. Okay, so today's session in sharpening, and I should say, those of you that are watching live, if you do have questions or want me to explain a particular thing, I'll keep my eye on the chat box. So I will go where you need me to go if you need me to do that. Otherwise, I will go forward with my topic of today, which is helpful, hopefully, for many of you, regardless of what you trade. If you're newer, this will help. If you're older, then this, when I say older, I mean you've been around in our community for longer, then you already know what I'm about to go through, which is essentially I'm going to run through very quickly because it takes often, 20 odd hours to do our entire course where you learn start to finish how to trade what we trade. But I'm going to go through our methodology, start to finish, sort of summary, high level, but so you can see what the different structures are and what it is that we're doing, bit to bit and start to finish. Now, like I said, it usually takes 20 odd hours to explain all of these things in depth, explain what these words mean, explain why it is that we do that way. For the purposes of today, I will give each of them, of course, enough explanation for you to understand what I'm saying, but I'm not going to go into lots and lots of depth. I've only got an hour to do it, but hopefully it will give you context and it's something you can come back to if you find yourself in a position where you're following one of our trades and you don't get why we did something or something like that. Okay, so just to use what we have here, I've got a nice blank space for me here. Essentially, the three main things that we are going to be doing when we're trading. There are other rules that come, but essentially it's three main things that we're looking at, three main components that need to line up for us to be able to place a trade. The first thing is auto climate. And when I say first thing, this literally is the first thing we look at, because if the auto climate is not giving us what we want to see, we don't even move on to the rest of them. So first things first is auto climate. That's the first thing we look at. Auto climate essentially means, and let me maybe change color here. Auto climate essentially means using technology to define the likely upcoming market direction. Meaning, is that market that we're looking at on that time frame that we're looking at likely to move up, likely to move down, or not likely to move in either direction? We need to answer that question first and foremost, because if it doesn't have probabilities to move up or down, then we shouldn't really buy or sell. Equally, we could use it to our favor in options, where we might say, okay, it's not got probabilities to move up or down. Perhaps I take advantage of straddling price in that way. So first things first, auto climate needs to be the first thing that we do. It's going to dictate the rest of what we do. The second thing that we're using is auto UFOs. Do we find, so let's again use pink here to show that. So finding places to buy or sell, depending on where big stacks of other buyers or sellers are. So what that means is if the market has probability upwards, so coming back to here, auto climate tells us probability is up, then we should look to buy, because probabilities are that the market moves upwards. So we don't want to sell a market that's going up. We want to buy a market that's going up. But where do we do that? Where's the right place to do that? Could you just, and we'll talk about this as we go, just do this top one and just say, I will buy if it's blue, I will sell if it's red, and that's it. And that's all I'm going to do. Yes, you could. I would say maybe that makes more sense on bigger time frames rather than small time frames, but yes, that's something that you could do. But what that could mean is that you're buying in the middle of nowhere with no place to objectively get out if you're wrong. You're selling in the middle of nowhere with no place to objectively get out if you're wrong. You also don't know where to take your profit target. So even if you're right, where do you get out? And what that does is it implies a lot of subjectivity, that you decide where you're wrong and where you're right based on how you feel that day, or based on something you read, or based on something that you think, all of which is subjective. We want to have objective places to buy and sell, objective places that we know we're right, that we know we're wrong, where we take a loss, where we take a profit, all predefined and objective, as mechanical and robotic as we could be, so that it's easier for us to make sure that our results are more regular, they are more or less erratic, shall we say. Our results will make a lot more sense if what we're doing makes sense, and it can only make sense if we're acting mechanically as much as possible. So auto UFOs help us find places where we're going to specifically buy or specifically sell and define what that means. The third thing, so remember I said there were three main things that we look at, is the EMA. So three different technologies here. We look at the 9 EMA. This helps us to specify the UFO, and I can't do an and sign. Let's do that. So it helps us to specify the UFO. So if we've got different choices, which one do we use? The EMA helps us do that. And again, also defines trading decision. We need these two things combined. So I'll expand on all of this and show you with these tools. But these are the three main things that we're doing. We are, in fact, what I'll do, I might just, oh no. I was going to say I might just snapshot that so that we've got it and we can bring it back again, but I've just deleted it accidentally. So instead, let me just quickly put this back up. It was number 1, auto climate. And again, we'll go through that. Number 2, auto UFOs. And number 3 is the 9 EMA. So these are the 3 different technologies that we use in that order of importance. You could, and I always say this on all of my sessions, and I know for some people they don't want to be told this, you could decide to use all of them, none of them, one of them, 2 of them, in whatever order you want. It's ultimately up to you to decide what you trade, how you trade it, and what your rules are. We are simply sharing what our rules are and in the order that they come, and the logic as to why we've done that. But that doesn't mean that other combinations or other apps or other strategies or applications can't also work. There are probably millions of different ways that somebody could be trading, especially when you have I want to say at least hundreds of different indicators you could use. Combine all of those together. You could put 2 of them together, 3 of them together, 10 of them together, all in different ways. You end up with infinite choices that you could come together. And that's just in using indicators, let alone fundamentals, let alone pattern recognition, let alone whatever else that you might use, whatever other logic that you might use on different timeframes, on different markets, with different risk, different target placement. There are millions of different ways that we can trade. Anybody out there that tells you they have the only one that can be consistently profitable is probably lying, or at least ignorant to a lot of other combinations that may work. So this is our combination. This is what works for us. And this is what I'll explain and why we do it. But like I said, there are things that you might say, do you know what? I'm going to use the auto climate and the 9 EMA and not the UFOs. Or I'm going to use the auto UFOs and the 9 EMA and not use the climate. Or I'm going to use the climate and the auto UFOs and not the 9 EMA. Or I'm going to use all 3 of those and I'm going to add in Fibonacci's as well. Or I'm not going to use any of them and I'm just going to use Fibonacci's. Whatever. Ultimately, you choose. Whatever strategy that you use, my advice would be the main thing we want to do. We want to make sure that you are as objective as you can be. That means being mechanical. Try and remove all forms of bias, and that means intellectual bias as well. A lot of people, and I've worked with a lot of people over the years, that think that because they're clever people and because they're reading from publications that are well respected, that therefore that must mean that they're going to make the right decisions when they trade. And unfortunately, it's just not true. There are lots of clever people in the world. There are lots of respectable publications. If it was simply the case that you needed a averagely to reasonably intelligent person to read a publication that's public for the world to see and make a decision on it and go and trade profitably, there'd be a lot more people that were profitably trading. Unfortunately, there is an element of bias in anything that involves our intellectual process. There is an element of bias in anything that involves the countries that we trade, even the stocks that we trade, the currencies that we trade, because we're going to have a feeling towards them. So we want to remove it as much as possible when it comes to why we're actually trading, what's the mechanical process of our trading methodology. Subjectivity comes in when we are initially deciding what to trade and how much money we have and what we're going to risk. Those things are subjective and should be. But when it comes to looking at a chart or looking at a stock or looking at a currency or a futures contract or whatever we're looking at, and deciding what to do, where to buy, where to sell, when to buy, when to sell, what to buy, what to sell, that should be a mechanical objective process. So we need to make sure that it's objective and mechanical, and we need to make sure that it is tested, and I would say practiced. And what I mean by that, back test it and then demo trade it. Don't just prove that it works in theory in the past, demo trade it and prove that it works in practice with you actually doing what your back testing showed you would happen. Then you can move forward with it. Don't just throw money in an account, watch a video, decide you know what you're doing and start trading. I've done that before. We've all done it, but it's not the best way to make sure that we make money. So in general, whatever you do, these are the rules. Be objective, be mechanical, make sure that you test it and that it's practiced. What you do outside of that is completely up to you. I am going to focus on our 3 main rules, our 3 main pieces of technology that we use in the order that we use them, top to bottom, start to finish, how we use our methodology and what we do. So let's get rid of this or minimize it for now. Come back to a chart. Now, I am going to let's look at a really common thing that people look at all the time, euro dollar. In fact, the reason I'm not going to look at the euro dollar is because we have no buyers on this time frame. So let's look at the pound dollar. That one's actually a little bit annoying. I'll explain why in a second. Let's look at dollar Canadian. Okay, brilliant. Let's use this. Okay, so we have on the left-hand side a weekly chart, on the right-hand side a 144. Doesn't matter, again, in terms of timeframes, that's up to you to decide which timeframes you use. This would be a swing trader, a swing to position trader would be using these types of timeframes. We may also cycle through different timeframes on the right-hand side, but let's just assume for the time being, these are the timeframes we're looking at. So the first thing on our list was Auto Climate. That is this. This is a free app on most platforms that you can use it on. I'm using Top right now, which is our platform. All of our apps are integrated into it as part of the fee for the platform, as well as if you're an options trader, lots of options apps, technologies integrated as well. So with Auto Climate, free app on most platforms that you can get it on. With some platforms, it comes with the Auto UFOs, so you have to pay for that first, but most of the time, free app is Auto Climate. What Auto Climate does, and this is why it's the first thing on the list, Auto Climate gives us an idea, or the probabilities, as to where that market is likely to move. It does that with these different dots. Ignore the lines. I won't go into the depth of how the lines work. Focus on the dots. The dots show us where the probabilities lie. So if we have a thick blue dot, that tells us probability is to the upside. If we have a thick red dot, that tells us probability is to the downside. If we have a thin dot of either color, whether it's red or blue, as long as it's a thin dot, that tells us not enough probability either way. And that's really it. There's deeper things to Auto Climate. I've done videos in the past about this, about how the lines work and how many dots in a row and the statistics of it and things like that. We're going to ignore that for now and just focus on, do I have probabilities up, down, or nowhere? And I know that because it's either a thick blue dot, a thick red dot, or a thin dot. That's it. There's only three things it can be: thick blue, thick red, or thin of either color. That gives us the probabilities as to what we're going to do. Now, you could layer extra rules on top of this using the statistics from Auto Climate, but the foundation is checked off simply by the dots themselves. Now, the good thing about using technology to do this rather than figuring it out ourselves is that when we have to figure out ourselves what the trend is, so let's make this bigger and try and show my point. Let's give this a little bit less room. Cool. So look at that visually and tell me what the trend is. Well, are you looking for the most recent move? Because that's up. But if you're looking at this is a weekly chart, the last few months, well, that's sideways. And really, this has only just broken that high. So maybe you could even say it was a downtrend before that happened. You've got the EMA moving through this, and this is a 9 EMA, but of course you could have different types of moving averages. It doesn't have to be a 9 EMA, it could be a 14 or whatever number you want it to be. So you could use different indicators that go, okay, well, that's pointing to the upside, so that's up. But this one was pointing sideways, so that's sideways. That was pointing slightly down. Overall, this was a downtrend, maybe to most people's thoughts, but how do you define the rest? What I like about Auto Climate, and again, there are other apps you could use or other indicators you could use to help, you literally just look at, that's a thick blue dot, right, probability is up then. Probability is that the market moves up. That's a thick red dot. Probability is that the market moved down. And if we follow this, that red dot was on the day that, oh yeah, the market did move down. And it moved down the following day. We had a lower low the next day, and we had a lower low the next day, all while Auto Climate was telling us that that was likely to happen. Now, is Auto Climate always right? No, nothing is. So on this day, it was a thick red dot, and that was actually the day that it started to go up. So then the next day, or this was a weekly chart, so the next week, it then said to us, not enough probability either way, it's not sure what it's doing. It might be changing direction, it might be pausing on its way back down, doesn't know what it's doing. The next week, when, oh look, of course, the market went up that week, Auto Climate was telling us that that was likely to happen. So like I said, like anything, it's not always going to be accurate, but more often than not, when Auto Climate tells us that's where the probability lies, That's where the probability lies. For many reasons, it's doing a bunch of calculations in the background that we could not do in the seconds that it takes to do here in order to find the answer to that. It also means we are not having to think about it too much, which means we don't have error. We are humans. If you've got to calculate that yourself or you've got to look at it visually, you might change day to day depending on how tired you are, how hungry you are, or how much data is loaded, or what you're looking at, or what you read that day, or a video that you watched where somebody said something different. You might be changing your rules all the time as to what counts as an uptrend or a downtrend or a sideways trend. Again, AutoClimate just tells you. It might as well say uptrend, downtrend, sideways trend. That's what it's telling us with those dots. So we answer that question first. That then helps us figure out if the trend is up, if the climate is up, if the probability is up, thick blue dot, probably buy. If the trend is down, the climate is down, the probability is down, you should probably sell. No point buying in an environment where probabilities are that the market moves down because we'll lose money. No point selling in an environment where the market is moving up because we'll lose money. So we let the climate guide us in terms of whether or not we buy or sell. Now, could you just leave it there? Like I said, yes. You could, in theory, let's say you could have sold. Let's say you sold right at the top of this day. So you sold here. And you were just lucky that it happened to be at the top of that week. You sold there. And then by the time the climate became sideways, was this one. So perhaps you bought back here, perhaps you bought back at the bottom of that candle, in which case you made a bit of money, or perhaps you bought back at the top of the candle, depending on when you looked at it in that week, and then you lost money. It's random, it's subjective, it's when did you sit down and look at it. You could have, in theory, bought, let's just show you, and this is again assuming that you just do this, you could have bought, let's say, the open of that candle, so you buy there. And by the time the market changed its mind, no longer had probability to the upside, we were on this candle. So maybe you sold out here and you made a little bit. Maybe you sold out here and you made a lot. Maybe you sold out somewhere in the middle and you still made a little bit. But again, what you made, 3 different people or 100 different people that made the decision based on when I look at it, is it just a climate or not, are going to have made vastly different amounts of profit. In the other example we showed, you could have profited, you could have lost, depending on which time of the week you looked at the markets. So it leaves a lot more to luck, it leaves a lot more to chance, and it leaves a lot more to subjectivity. So we don't just leave it at AutoClimate, we take it that step further. So now that we've got an idea, in this case it's a thick blue dot, so we'll look to go long. Then we want to know, where will we go long? Meaning, at what price would be the favorable price to buy at, rather than right now, whatever it is as I'm looking at it. How do we make this more objective? How do we get a specific area where we have objective proof if we're right or objective proof if we're wrong? This is where we now look to the second thing on our list, which is auto UFOs. So auto UFOs are these guys. We have green ones, slightly different shades of green, but still green. Those show us where the buyers are. We have red ones, sometimes be a darker shade of red as well, but they are still showing us sellers. Red ones show us sellers, green ones show us buyers. Auto UFOs are doing a lot of calculations based on patterns, based on volume, based on upticks, downticks, all kinds of things, and they are coming back and showing us in this area there are buyers waiting to buy. In this area there are sellers waiting to sell. Why is that useful? Because if we've decided that we're buying because we've got probability up, and we also buy in one of these, then we are buying with other buyers in an environment where probability is up. The more buyers you have, the more likely it is that price goes up. There's more demand. There's more likely to be more buyers than sellers. like anything in life, if you have oil again is also something we can trade, but take the prices of petrol or gas, wherever you are in the world, whatever you call it. Petrol is very expensive now compared to what it was a year ago. When COVID first hit and the pandemic shut everything down, the price of oil went to next to nothing, relatively. Price of oil went to next to nothing. Why? Because no one wanted to buy it, because no one was using it. Now there have been other things that have happened, wars and supply issues. The supply's gone down and people are buying it more, therefore it's gone to over $100. I know it's pulled back a little bit since its high, but it shot up very quickly because it was just the amount of buyers versus the amount of sellers. So lots of buyers push price up, lots of sellers push price down. So we want to know where they are so we can buy with them and be specific about where that is. So we've now got on the right hand side, on the smaller time frame, and it's always going to be the smaller time frame on the right hand side. We give guidance as to what timeframes those should be, depending on which timeframes you use on the left. But really, as long as it's smaller, as long as this one is smaller than that one, but not too much smaller, you're fine. So for example, for me, if I use weekly on the left, I will use a 144, a 1 day, a 2 day, and a 3 day. You could also use a 2 hour, a 3 hour, a 4 hour. You could use whatever other Fibonacci numbers within there as well if you want. For me, I'm just using a Fibonacci minute chart and then a 1, 2, and 3 day. Those are the 4 that I use. You could choose different ones. As long as you don't use one on one day and one on another day for no apparent reason, you just feel like changing it. As long as you're consistent about which ones you look at and which one you choose, it's fine. So we have weekly on the left, 144 on the right in this case, so a smaller time frame on the right. We're now looking for buyers. We look for buyers because we know we've got a thick blue dot, probability up. We have 2 stacks of buyers being shown to us. I don't know where there is being shown to us on the right hand side. Does that mean that we place an order to buy here and an order to buy here? And also as well, we also use UFOs to figure out where our stop is. We place a stop loss just underneath here and a stop loss just underneath here. Does that mean we just go and put those trades on? We can, of course. You could leave it at that and literally just use UFOs. Don't worry about the EMA at all. You could do that. What's the problem with that? Is that, let's say you could find a way to differentiate which of these had the greater probability, and you find out that actually this one has the greater probability, which in this case it doesn't, but we'll assume it does for a second. Let's say you assume this one has the greater probability. Why would you put this trade on? For price to come through it just to react to the one you knew had better probability anyway. So you lose for you to be able to win. Makes no sense. So that's why we add the EMA on, which is this number. We use the 9 EMA, so the 9 exponential moving average. That's the third component. And we say, where is that on the bigger time frame? Why? Because if price is, so the EMA is at this price here. Current price is here. If current price is above the EMA, which it is, and then comes down to meet it, people buy. Many people all over the world buy. Whether that's the right or wrong thing to do, it just is what people do. So buyers come in at that point. So let's say that EMA number, for the sake of argument, we're going to say that that EMA number fell inside of here. Then we would have buyers at the EMA price inside a stack of buyers. So more and more buyers piling up in the same place gives it more probability that price moves up from there. In this case, it doesn't actually. The numbers don't work, but we're going to assume that it will just for the sake of argument. So that then tells us if the EMA lines up with this one, then this one's the one that we place. This one's the one that we take. We don't take this one because although it might work and we might see price come down and move up from the top one, and we'll be a little bit annoyed that we missed that opportunity, we know that this one has more probability. So it's more likely the price moves through that one before it reacts to the bottom one and then goes from there. So we use the EMA to help us differentiate between UFOs to decide which one to place, but also to decide whether or not we place the trade at all. So in this case, let me just delete those for a second. In this case, we could have this trade. So we've got buyers there. We could have this trade because we've got buyers there. In the previous example, for the sake of argument, we said, let's say that the EMA was inside this one, but actually it's not. So this EMA is 1.2724, which is here. Choose a different thing, which is here. Yeah. So that EMA number, that line, is not lining up with this green box. So we don't trade at all. So you could use the EMA to help differentiate between UFOs, but we can also use it to say we don't have those two things combined, therefore we don't trade. Now again, could you be somebody that says, I will just use the auto climate and then whenever price hits the EMA, I buy it if I'm going to buy, or I sell it if I'm going to sell. Just wherever price hits the EMA, I do that based on the auto climate telling me to either buy or sell. I'll either buy or sell if it hits the EMA. Yes. But by doing that, although you are in theory buying at a more ideal price or selling at a more ideal price, where's your stop loss? How do you know if you're wrong? For us, in using UFOs, we know we're wrong because if that's where all the buyers are and price moves through it, well, there weren't enough buyers then we're wrong, we get out. So we can use that to not only tell us where to buy, but where to sell if we're wrong. Because objectively speaking, if there were enough buyers here to push price up, price cannot move through that area. Can't keep going lower if there's loads of buyers there, enough to move it up again. So if it's got to through here and it breaks the bottom of that box, we're out of there. We'll give it a little bit of wiggle room, especially in FOREX to account for the spread. Give it a little bit of wiggle room. But other than that, if it's gone to the bottom of that box, we're out because that's an objective place we're wrong. There's no arguing with that. There's no subjectivity. Subjectivity might come on the amount of wiggle room you give it, but you are still using the bottom of that box to dictate to you where your stop loss should be. So again, you could just buy at the EMA if you want, but that gives you no definition as to protect yourself if you're wrong. And why do we use stops in the first place? Because if I buy here and I have no stop, so nothing that gets me out automatically if I'm wrong, and I'm very wrong and price just keeps coming down and down and down, I could lose a lot of money. I'd rather get out here where I'm proved objectively wrong, where I'm proved that whatever logic or methodology I was using didn't work for me here. Get out. And you lose this much. Times by however many lots you're using or contracts or shares, whatever. You lose that much, not this much. Sometimes those movements can happen overnight or happen in a few minutes off of some news or something. So we have stops to protect us. We should do with whatever methodology we use. Auto UFOs gives us an objective place as to where to put that stop and an objective place as to where to actually buy into the uptrend or sell into the downtrend. So let's take another example and go to the sell side. So let me look at where price might be down. Okay, so let's have a look at the Euro Canadian. We'll come back to the other example in a minute actually to show you the last bit here. So in this case, we have, and I'm going to just look at a different time frame here. I'll make my point. Let's stick with this one. Okay, so here we have a thick red dot. That tells us probability is down. So exactly the same as before, just invert it. Rather than buying because probability is up and therefore looking for buyers, we're going to sell because probability is down. So we look for sellers. So red aligns with the red. Sellers align with sellers. Buyers align with buyers. It's following autoclimate to dictate to us which UFOs we should be looking for. So we've got a thick red dot, probability down. We therefore want to look for sell orders, sell UFOs. We have red UFOs here. We have 3 of them. Again, they are giving us defined places that we sell if it hits that, and we would buy out, in this case as a stop, at that point. You could sell here, enter the trade, going short. We put our stop loss there. Buying back in this case, because if we sell to get into the trade, we have to buy to get out of it. Buying back slightly higher and therefore losing. And same with this one. So we've got 3 choices. How do we know which one to use, if any? Come back to the EMA. The EMA on the bigger time frame is showing us 1.3761. Now that is here-ish. It's currently not lining up with that UFO. Now, in this case, I actually would place this trade, and that's because as price moves, so too will the EMA. Now, if the EMA was really far from that UFO or the other side of that UFO, then as price moves up and the EMA moves up, they wouldn't catch each other. But because the EMA is close to that UFO and below it, as price moves up and the EMA moves up with it, it's likely that by the time price would enter us into this trade anyway, the EMA will have moved up to join it. So you'd put that trade on and you just track it, or have alerts on just to check that your assumption of what will happen or your expectation of what will happen is correct. If price moves up to meet the UFO and the EMA doesn't quite move to get into it, then you'd cancel the trade. But we're going to assume for now that our logic here is sound and that it's likely that that will happen. So by the time price would move up to enter into this trade, our EMA might be slightly inside it. So great, we'd place that trade and we would use that, and that would be our short position. Again, using the EMA in this case to say the closest one is the one we use. If the EMA was maybe here and it will move up and enter into this one, or already there or in that one, then we pick that one. So it's objective. We're not picking the bottom one because it's the closest. We're not picking the middle one because we like it. We're not picking the last one because we like the numbers. It's objective. Where is the EMA? Which one is it coinciding with? If it coincides with one of them, we place it. If it does coincide with any of them, we move on. Place a different trade. We look for a different opportunity. So it's very objective. Do we have a thick blue dot or a thick red dot? If we have a thick blue dot, we look to buy. If we have a thick red dot, we look to sell. That has to be the first thing that we look at. Because otherwise we're looking at UFOs without knowing which of them we actually care about or which of them we want to use. So we use that first. Then we say, okay, if we want to sell with sellers. Where are the sellers? We find them. Got a bunch of sellers. Which ones do we pick? We use the EMA. Where is that likely to be falling by the time price moves towards it? This one. Great, we use that one. That's our trade. Now, we're going to come back to what we're looking at, dollar Canadian, I think. I'm going to come back to this example to then also show where we put our targets. So we understand now where we're going to put, if we've got, we don't, okay. We understand now where we put our entry and our stop loss. We also need a place where we're going to objectively be right or wrong. Well, sorry, we know the place where we're going to be objectively wrong. It's where our UFOs show us that we would be. What if we're objectively right? What if price moves in the direction that we think it will? Well, in which case we need to have an objective place to get out of the trade for a profit. So for us, we say, okay, well, if I bought the dollar Canadian in this case as an example, because probability was up, because I had buyers that coincided with the EMA. Now, in this example, it doesn't actually coincide. We're just saying that it does as an example to show you what you do in that case. I'm just going to have some water. My mouth's very dry. Apologies. Okay. So In this case, it doesn't actually line up, but let's assume it does. Well, I'm buying because probability is up. I've also got a bunch of buyers that are likely to be met with another bunch of buyers by the time price got there. So I've got buyers, buyers, and buyers. What stops buyers? Sellers. The only thing that can stop buyers is sellers. If there's enough buyers, price will keep moving up until sellers come in, and then they might come down again. Now, that's not to say, by the way, that every single time, because it's nowhere near that, not to say that every time you buy because the climate says so and because everything lines up, that price will always go to the next UFO, to the closest red one. That would be great if that happened every time. Of course not. Why? Because right now, the way the markets are right now, these are the closest sellers. But let's say we got into the trade, so price came back down, we got into the trade at, say, this point. Let's say that our stop loss using this one was here, whatever. We would therefore have our target up here saying we are going to take this until the first objective place where we could be stopped, which is sellers. But on its way up, price might pause a little bit, moves up a little bit, pauses a little bit, and therefore our climate changes. Therefore, we no longer have probability up. Why are we in a long trade if we no longer have probability up? We shouldn't be. We get out, and we actually end up taking profit here. Or maybe price moves up and then a new red UFO is formed, meaning new sellers are coming into the market. We've got old sellers up there waiting, but new sellers have now come into the market and price starts to fall. So maybe then our target moves from here to here, providing we still have the climate up, and then price might move back up again and hit our target. Or it may be that we don't even see a new UFO form, but new sellers come into the market and price is going up and then it just moves against us. And maybe we end up taking profit somewhere around here. Maybe it only goes a little bit in our favor in the first place. Maybe it only goes to here and then drops straight through. Because again, maybe there weren't enough buyers. Maybe new sellers come in and we don't see them come in. So it's not to say that objectively, meaning like 100% that's going to happen. We say objectively because right now, with everything that we can see, the only place where we can objectively put our target is where we have sellers because we're buying. So sellers stop buyers. So we get out before we get there. So if that starts at 1.3491, maybe we get out at 1.3490. And we get out just before we hit the sellers. In the meantime, there could be things that change or new sellers come in or the buying pressure stops for whatever reason, and we might get out in between that. So we have to have management of our trades on top of that as well. Or you could just leave it. You either lose that little bit or you make that lot. Hopefully, in the end, it averages out that you make money. We would suggest having some sort of trade management to lock in those profits where it's moved a little bit in your favor at least. So, different apps that we're using, different technologies that we're using. We are using AutoClimate in the same way to help us get into the trade, in the same way that we we use it to help us manage our trade. If we have probability up, then we're going to look to buy. If we're already in a buy position and we no longer have probability up, meaning it's become a thin dot or a red dot, we no longer have probabilities on our side, so we get out. So we use that for the same things. Auto UFOs we use to help us on the right-hand side find a smaller area where we can follow the trend that we've gotten from the climate. So in the case of an uptrend, an up climate, probability up, we want to look for areas to buy. We use the EMA to help us decide which one we use, if any. And then where are we going to take our target? It's going to be sellers. Let's now show an example the other way around. So let's look at, Let's look at New Zealand dollar, see what's happening there. I'm using, tell you what, let's look at a stock. I'm using currencies, but let's look at a stock. Great. Okay. So in the case of, we're looking at Facebook right now. Still just loading for a second, but let me see if I can find a good example. I'm going to try and find a good example for us that actually lines up, because it's going to help make my point. We could pretend it lines up, of course, but it's always helpful if it actually does, because then it makes a little bit more sense. Let me have a think. Google, nope, too far away. I'm going through FANG stocks here, but they've gone down quite a bit. I'll tell you what I'll find. Let's use our scan. Might not work today though, because the markets are closed, but maybe it will. Let's try and have a look at some of these. This one might line up. Nope. If not, if I can't find one quickly, then I will go back to just pretending that it lines up. But like I said, I'd rather look at one that actually does line up, because it will help us to be more specific about what we're talking about. Okay, I'm look at two more. And we'll look at it randomly. See if we've got places to do this. So not that one. So let's see if we've got, that says owl. Owl looks like fun. Let's see this. If not, I'll draw it on. Actually, we can draw it on. Okay, I'm going to draw it on. So we'll do it that way. Oh, we can't even do this one because it doesn't have bias. Okay, let's pick whatever random one now, and then I'll draw it if I need to. Okay, let's have a quick look. Okay, nothing. Okay, right, I'm going to draw it. So coming back to our point, so I've just shown you with buyers and buying what we do, and the sort of three main technologies that we use, and then adding on that target element. So we're now just going to do it to the downside to give context for short positions so that we can understand how it works either way. Again, I'm going to have to draw on what I mean rather than use what we actually have in terms of opportunity in the markets, but hopefully it still makes sense. So in this case, this is a stock, it's New Star Energy. Thick red dot, probability down. If we're going to have probability down, we want to sell. Where do we want to sell? With sellers. Now let's also assume that we have sellers. Let's assume that they are here. And let's assume, just try and draw it properly. So we've got, come on. Doesn't want to draw a circle, so let's draw it like that. Let's assume that the numbers are 1550 to 1580. Okay, so let's assume that that's a real UFO and that this is what happens. So we have thick red dot, probability is down. We have found sellers. We have three of them. We've got this one, we've got this one, we've got this one. Which do we use, if any? It's the one that lines up with the EMA. What is the EMA? The EMA is 15.55. So it falls just there within our red UFO. So that is now where we will be selling. Again, objective. It's not, there's no subjectivity here. That's thick red, so we look to sell. Where do we sell? We sell where we have sellers that coincide with the EMA, assuming this is real. So our entry, so use blue line for the entry, will be 1550. Our stop loss, we'll use a red line for that, will be just beyond the 1580 mark, giving us a little bit of wiggle room. Let's call it 1590. That's our entry and our stop. So again, let's draw that. Might look like this. On the bigger time frame, obviously, might look like that. Where are we going to take our profit? Well, we're selling with sellers, with extra sellers in the context of a selling environment? What stops sellers? Buyers. And here they are, green UFO. So our target will be down here. That's 10.45. Maybe we make our target 10.46. Could be 10.45 if you want, 10.47, whatever. Just as those buyers start, or just before that. Meaning this becomes our risk. This becomes our reward. Now, is it likely that price moves all the way from here to here without anything changing that? Not as likely. If it does, great, we're happy with that. But if price moves a little bit in our favor and then starts to stall or move against us, and the climate changes, we get out and we take our profit early. If price just moves straight against us because new buyers come in or there weren't enough sellers, fine, we lose. We risked what we wanted to risk. We had a stop loss to protect us. So that's what happens there to the downside. So coming back, let me just move this right over. Coming back to what we spoke about right at the start, which is that, oh, where am I? I'm here. Lovely. We look firstly at auto climate. We look down here because we want to know, are we going to buy or sell? That's why it's first. No point looking at UFOs and EMAs. No point if we don't know whether we want to be buying or selling. So we look at the auto climate first. If auto climate is undecided in most markets, the only market that this is not true in is options. Every other market, if the auto climate is a thin dot, then we just move on. We don't even look at it anymore. Rule number 1 isn't even met, so move away. Rule number 2, auto UFOs. Do I have, in the case of a selling environment, do I have sellers to support that? You might not have any for a while, so there's no point. Do I have buyers in an environment of buying that are going to support that? You might not have many, in which case don't do anything. Which of those do I choose? If any, I need my EMA. I need my EMA to tell me which of the sellers I'm going to sell with, which of the buyers I'm going to buy with, or whether or not the EMA is nowhere near them, in which case I don't trade at all. I move on and I look at a different opportunity. Where do I place my targets? Come back to auto UFOs to help me. Now, we also have another target somewhere in between. So we would have, let's take the same example. Let's say that was my entry. That was my stop. This was my final target. I want to take it all the way down here. We often will have, no, we always have, a safety target, that's what we call it, a target that is 1-to-1 away to protect us. That helps us if price goes a little bit in our favor and then something changes and it comes against us, then we make 50% of our risk and then we lose 50% of our risk. We break even. So we would have a safety target in. Again, could you do something different where you say, you know what, I'm going to place my target 3-to-1 away. So my target's going here, providing a UFO is not closer. So maybe you say the closest UFO or 3-to-1 away, or 4-to-1 away, or 2-to-1 away, or 10-to-1 away, or whatever it is. The closest UFO or a set number, whichever's the closest or whichever's the furthest. Could you have it where you take multiple targets and you take a 0.5-to-1 and you take a 3-to-1 and then you take the final one and you split it into 3 or 4 or 5 or 10? Could you just have the one target and do safety targets all the time, but just take 1-to-1s out of the market all the time? Just take little bits of profit all the time. Miss out on the big ones, but have more profitable trades. Yeah. You could be following everything else exactly the same, but put your target in a different place and see very different results from somebody else that follows the exact same methodology. Simply because you've chosen to put targets in a different place, which changes everything to do with your ultimate profitability, because your probability rate will change, likelihood of hitting your target changes depending on where you put it, and how much you make or lose depends again on where you put your targets. So many different factors go into every trading methodology. This is ours in a nutshell, start to finish. Are there things that you can change on each of them, ignore on each of them, add to each of them? Yeah. But make sure that we come back to the main point every time. The main point every time is that we want to make sure that we are objective and mechanical. None of those examples that I showed you, it wasn't, well, autoclimate's thick red, but there's this or there's that, so maybe I'll do this or that. It's thick red, so I look to sell. That's it. It's mechanical. There's no thought in that. There's no subjectivity. It is what it is, and that's what I do. Where am I going to sell? Are there sellers that line up with the EMA? Yes, there are. Great, I trade. No, there aren't. Fine, I don't. Where do I put my targets? At the opposing UFO and 1-to-1 away. That's it. It's mechanical. I don't need to think about it. I'm not using any intellectual process really, or decision making. It's not relying on how I feel. It's relying on what's the rule, what's the mechanism. So be mechanical, whatever it is. Doesn't need to be our methodology. Be mechanical. Second thing is test it. So make sure it's a tested strategy and make sure that it is practiced. Meaning, back test it. Often people don't even know what that is, which is shocking, but actually I didn't when I first started trading, so it's not widely spoken about. A lot of people might know what it is, but they can't be bothered or they don't know how to do it. Again, I was like that, but it took me a few years of losses before I realized I really needed to test things. Once I started back testing and I started getting excited about what my results were showing me, great, I'm going to go just trade it straight away. I then realized that just because something works in a tested environment, meaning in theory, if I'd have applied that strategy exactly at these times every day for the past 5 years, I would have made X amount of money per year. Unless I'm actually going to act on it and actually sit down at my laptop every time at those days and I actually risk that amount, I actually have that money or I actually have that time, of course I'm not going to actually get the same results. So we then need to practice it and say, okay, let's do it in a demo environment. Let's do it in a paper trading account. And let's actually enact it as I've tested it to see if in real life I actually do enact it in that way. To see if in real life I might have been sick, or I might have been on a plane, or I might have, maybe not on a plane recently, but I might have been, well, you might have other work or other things that you do, right? So maybe I didn't put it into practice every day. If I did put it into practice only 2 or 3 times a week, what does that actually do to my results? And then once you've collected that and you really know what you're doing, then risk your money. Again, I'm saying this as if that's what I did when I first started trading. It's not. I had to learn the hard way that that's what you should do when you first start trading. But whatever you trade, just make sure that that's what you do. You're objective and mechanical. Take all bias, all subjectivity, all intellectual process as much as you can out of it. Just have rules. Rules that you've tested and that you've practiced. Prove that it works, not just theoretically, but in your actual application of it in your life. Then risk your money. Those are the rules. Whatever you do around that, use whatever apps you want, use whatever indicators you want, have whatever rules you want. Just have rules that you've proved work, basically. Okay, so that brings us to the hour. So I've had a look. I haven't seen any chat questions come in, but if you're watching this recorded and you do have questions, you can email me, becky@tradictive.com, or you can go to tradewithufos.com/Becky. Book one-on-one coaching if you'd like. You can get apps and courses and group coaching. You can scroll down and track my live trades that I put on. We'll be starting that, I think, next week. And you can scroll down, ask questions in this environment, or you may find the answer to your question is already here because somebody else has already asked it. So let me know if you need any help. Please go to wherever you need to go for whatever support. Reach out if you need it. I will wish you a good rest of your weekend and a great start to your trading week on Monday. And I will see you then. Take care. Bye-bye. Can't find my mouse.